What if I told you that something is quietly building in the gold and silver markets right now? Something so unusual, so historically rare, that when it finally breaks, it's going to catch the vast majority of everyday investors completely flat-footed. And here's the part that's going to bother you. The people who understand what's happening are already positioning themselves. They've already made their moves. And if you close this video right now, you'll go on with your day not knowing that this setup even exists, while they quietly benefit from what's coming. By the end of this video, you're going to understand the exact macro and market conditions converging right now in gold and silver, why this moment is unlike anything we've seen in decades, and what it could mean for your financial strategy going forward. So stay with me. This one is important. All right, let's start from the beginning, because if you don't understand the foundation of what drives gold and silver, the rest of this is going to feel like random noise. And I don't want that. I want you to genuinely understand this. Gold and silver are not like stocks. They don't pay dividends. They don't have earnings reports. They don't have a CEO making decisions that affect their value. They are what economists and financial historians call monetary metals. And that word, monetary, is the key to everything. For thousands of years, not hundreds, thousands, gold and silver have functioned as stores of value. Not because some government told us to believe in them, but because they are scarce, durable, divisible, and universally recognized. These are the properties of real money, and no central bank in the world has figured out how to conjure them out of thin air. They've tried to replicate them with paper and digital currency, and in the short run, those systems work fine. But in the long run, and here's the thing that history keeps screaming at us, every fiat currency ever created has either collapsed or been massively devalued, every single one. Now I want you to hold that thought because we're going to come back to it, because what's happening right now in our monetary system is directly connected to what I believe is coming in gold and silver. And once you see the connection, you won't be able to unsee it. Let's talk about where we are. As of the time I'm recording this, the United States national debt has crossed levels that would have seemed science fiction to economists just 2 decades ago. The Federal Reserve, which manages U.S. monetary policy, went through one of the most aggressive interest rate hiking cycles in modern history, starting in 2022, raising rates from near zero to levels not seen since the early 2000s, all in an effort to combat inflation that peaked at over 9% annually in mid-2022, the highest since the early 1980s, according to Bureau of Labor Statistics data. That's not opinion, that's documented, verifiable fact. And look, the rate hikes did work, to a degree. Inflation came down. The Federal Reserve made that happen, and credit where it's due. But here's what most people aren't thinking about. The economy absorbed those rate hikes, but not without cost. The cost is showing up in government interest payments, in credit card balances, in commercial real estate stress, in regional banking vulnerabilities. The financial system took on enormous amounts of leverage during the near-zero interest rate era of 2009 through 2022, and now that leverage is being stress-tested in real time. The system is not broken, but it is strained. Stay with me here, because this is where it starts to connect to gold and silver in a way that most commentators are not fully explaining. There's a concept in economics called the real interest rate. It's the nominal interest rate, the one the Fed sets, minus the inflation rate. And this number matters more to precious metals than almost any other variable. Here's why. When real interest rates are positive, meaning the stated interest rate is higher than inflation, investors can earn a genuine return by simply holding cash or treasury bonds. There's no opportunity cost to not owning gold. Gold pays no interest, so when you can get 5% on a treasury bill, and inflation is running at 2%, why would you hold an asset that earns nothing? Most people wouldn't. And that's why gold tends to struggle when real rates are deeply positive. But here's where the setup comes in. And I promise you, this is the part most people aren't paying attention to. The Federal Reserve is under enormous pressure, from the markets, from the federal government's own interest expense burden, and from slowing economic indicators to eventually begin cutting interest rates. Now, I'm not going to sit here and tell you exactly when that will happen, or by how much. Nobody knows that with certainty, and anyone who tells you otherwise is selling something. What I can tell you is that history is very clear on what tends to happen to gold and silver when we enter a rate-cutting cycle, especially one coming off an elevated inflation environment. Real interest rates compress. The opportunity cost of holding gold drops, and capital that was parked in high-yield cash instruments starts looking for a new home. Think about that for a second. We're talking about trillions of dollars sitting in money market funds, which, as of recent reports, had accumulated over $6 trillion in assets. $6 trillion sitting in short-term yield instruments. When those yields start dropping meaningfully, what happens to that capital? It moves. It has to move. And one of the places it historically moves is into hard assets, into commodities, into gold. And now I want to introduce you to the second piece of this setup, the one that I genuinely believe is being almost completely ignored in mainstream financial media, and it has to do with silver specifically. So if gold is the headline, silver is the story underneath the headline that changes everything. Silver is unique among precious metals because it is both a monetary metal and an industrial metal. Roughly half of global silver demand, based on data from the Silver Institute, comes from industrial applications. We're talking about solar panels, electric vehicles, semiconductors, medical devices, and electronics of every kind. Silver is one of the best electrical conductors on the planet. You literally cannot build a solar cell without it. And as the world undergoes what policymakers and analysts are calling the energy transition, the shift from fossil fuels to renewable energy, the structural demand for silver is being projected to rise significantly over the coming decade. Here's the part that should make you pay attention. Global silver supply is not keeping pace with this demand trajectory. Mining output has been relatively flat. New silver discoveries are not coming fast enough to offset the anticipated demand surge from solar and EV manufacturing alone. The Silver Institute has published data suggesting that in certain recent years, the silver market ran a physical deficit, meaning more silver was consumed than was mined and recycled. When a commodity market runs a persistent deficit, the math eventually forces prices higher. That's not ideology. That's supply and demand. The most basic economic principle there is. And I'll be honest with you, this is where I get genuinely excited, because I've been watching this setup build for a long time, and I think most everyday investors have no idea it exists. Now, I always want to be upfront with you. This is educational content. I'm not your personal financial advisor, and everyone's situation is different. What I'm sharing today is based on general principles, observable market data, and my experience analyzing these markets. But before you make any major financial move, please talk to a licensed professional who knows your specific situation, all right? Good. Let's keep going. Let me give you a third piece of this puzzle, because there's a global dimension to what's happening in gold that most American investors are simply not focused on. And it's this. Central banks around the world have been buying gold at a pace not seen in decades. According to the World Gold Council, central bank gold purchases hit record or near record levels in recent years. Countries like China, India, Poland, Turkey, and several other nations have been systematically adding gold to their reserves. Now, why does this matter to you sitting here in the United States? Here's why. Central banks don't buy gold because they think it'll spike next quarter. They buy gold because they are managing long-term reserve strategy. They are making a statement about what they believe the monetary system is going to look like over the next decade or two. And when you have nation after nation quietly, consistently accumulating gold, that is a demand signal that operates completely independent of retail investor behavior. It's a structural bid under the market that doesn't go away when sentiment shifts. And here's the thing that really ties this together. We are living through a period of what many economists are calling de-dollarization, a gradual diversification away from the US dollar as the world's dominant reserve currency. Now, I want to be careful here, because I am not saying the dollar is about to collapse tomorrow. It isn't. The dollar remains by far the world's most important reserve currency, and that's not going away overnight. But the marginal shift, the slow, steady diversification of global reserves away from pure dollar holdings and toward gold, creates a persistent, long-term tailwind for gold prices that is genuinely structural in nature. Not hype. Structural. Before we go any further, and I mean this, you need to understand what I'm about to explain, because this is the part that most people completely miss when they think about gold and silver as investments. And it has to do with how you actually gain exposure to these metals, and what the differences between those methods really mean for your money. There are essentially three ways most individual investors access gold and silver: physical metal, actual coins and bars you hold in your hand, exchange-traded funds that track the price of the metal, and mining stocks, companies that pull the metal out of the ground. And each of these behaves very differently in various environments. Understanding the differences is critical. Physical gold and silver, coins, bars, stored at a trusted depository or in your own safe, give you direct, unencumbered ownership. There's no counterparty risk. You own the metal, period. The downside is liquidity and storage costs. If you need to sell quickly, it's not as fast as hitting a sell button on a brokerage account. But for people who are primarily concerned with wealth preservation against systemic risk, currency debasement, financial crisis, physical metal is what historically made the most sense. It's the version that has survived wars, defaults, and monetary collapses throughout history. Gold and silver ETFs, like the SPDR Gold Shares, which trades under the ticker GLD, or the iShares Silver Trust, which trades under SLV, these are financial instruments that track the spot price of the metal and are backed by physical holdings in a vault somewhere. They're incredibly convenient. You can buy and sell them like any stock in your brokerage account, including inside a traditional IRA or Roth IRA. The trade-off is that you don't own the physical metal directly. You own shares in a fund that owns the metal. For most investors who are looking at gold and silver as a portfolio hedge, not as a full monetary system replacement, ETFs are a practical, low-friction way to get the exposure. Mining stocks are a different animal entirely. When you buy shares of a gold or silver mining company, you're not just buying exposure to the price of the metal. You're buying a business, one that has operating costs, labor challenges, geopolitical risks in wherever it mines, management quality, debt levels, and all the complexity of any other publicly traded company. The potential upside in mining stocks can be significantly larger than the metal itself when conditions are right, because these companies operate with a kind of natural leverage to the underlying commodity price. But the downside risk is also magnified. I've seen plenty of situations where gold prices moved higher, but a particular mining stock went nowhere or even fell because of company-specific problems completely unrelated to the commodity. Seriously, though, the point is not to tell you which of these three paths is best. The point is that they are genuinely different, and the right choice for you depends entirely on your financial goals, your time horizon, your risk tolerance, and your overall portfolio construction. That's why, again, a conversation with a licensed financial advisor who knows your full picture is so valuable. Now, let me pull back and give you the big picture, because I want you to understand what the convergence of everything I've described actually looks like when it comes together at once. And this is the part I called the setup nobody sees, because individually people talk about one or two of these factors. But the combination, the real interest rate dynamics, the central bank accumulation, the structural silver supply deficit, the energy transition demand story, the massive pool of capital sitting in money market funds that will need to relocate when yields compress. That combination is something I genuinely believe is underappreciated. Here's a useful historical analogy. In the early 2000s, gold was trading around $300 per ounce. It had been in a bear market through the 1990s, largely because real interest rates were positive, the dollar was strong, the stock market was booming, and there was very little reason for capital to rotate into precious metals. But underneath the surface, a setup was building. The dot-com bubble burst. The Federal Reserve slashed rates aggressively. The war on terror increased government spending and deficits. Faith in financial markets was shaken. And over the course of the decade that followed, gold went from roughly $300 per ounce to over $1,900 per ounce by 2011, an increase of more than 500%. Now, I am not saying that's going to happen again in the same time frame or with the same magnitude. Past performance does not guarantee future results. That is a fundamental truth of investing, and I'd never try to mislead you otherwise. But the point of studying that history is to understand what happens when multiple structural tailwinds align simultaneously, when the macro environment shifts from working against an asset to working in its favor on multiple fronts at once. And I promise you, what I'm about to tell you in just a minute is the part that connects all of this to what you should actually be thinking about for your own financial picture. Let's talk about portfolio allocation for a moment, because I think this is where a lot of people get confused or paralyzed. When financial advisors and economists discuss precious metals as part of a diversified portfolio, they're generally not talking about going all in. They're talking about a strategic allocation, historically somewhere in the range of 5 to 15% of a portfolio, that serves a specific function as a hedge against inflation, currency debasement, and systemic financial stress, not as your primary growth engine, not as a get-rich-quick play, as a hedge, an insurance policy against the scenarios where traditional financial assets struggle. Think of it this way. Your portfolio is like a house. Stocks and bonds are the foundation, and the walls. They do most of the structural work. But a well-built house also has a roof. Precious metals in a diversified portfolio are like that roof. They don't do anything flashy most of the time. But when the storm comes, you're really glad it's there. Now, one thing I want to address directly because I know it's on the minds of a lot of everyday Americans right now, and that's the question of timing. People ask me all the time, is it too late to buy gold? Prices have already moved up a lot. And here's my honest answer. I don't know. Nobody knows with certainty where prices are going in the short run. Markets can stay irrational longer than you can stay solvent. That's a famous and very true observation. But here's the thing about structural investments. If you believe, based on the macro factors we've discussed, that the long-term environment is fundamentally supportive of precious metals, then the question of whether you buy today versus 3 months from now or 6 months from now becomes less important than whether you have any position at all going into what could be a sustained move. The investors who missed the gold rally of the 2000s didn't miss it because they waited a few months. They missed it because they were never in it at all. No one talks about this enough. The role that dollar-cost averaging can play in precious metals investing. If you believe in the long-term thesis, but you're worried about buying at a short-term peak, one approach that many financial professionals discuss is the idea of making regular, fixed dollar investments over time, weekly, monthly, whatever fits your cash flow, rather than trying to time a single large entry point. This approach, often used with stocks and index funds, can apply to gold and silver ETFs just as effectively. It removes the psychological pressure of trying to call the perfect moment, and it smooths out your average cost basis over time. It's not a magic solution. It's just a disciplined approach to building a position when you believe in a long-term thesis, but acknowledge that short-term price movements are impossible to predict consistently. And look, I know some of you watching this are thinking, this all sounds interesting, but I'm barely keeping my head above water. I've got credit card debt. I've got student loans. I'm trying to keep up with grocery bills that feel like they've doubled in the last few years. And I hear that. I genuinely do. If you're in that position, the most important thing I can tell you is this. No investment, not gold, not stocks, not anything, should come before paying off high-interest consumer debt. Period. If you're carrying credit card balances at 20%, 24%, 28% interest, and those are real numbers that many Americans are dealing with right now, paying off that debt is the highest guaranteed return available to you. Because there is nothing in the investment world that reliably returns 24% annually. Paying down a 24% interest rate debt is mathematically equivalent to a 24% guaranteed return. Do that first. But once you're on stable ground, once you've got that high-interest debt under control and you've built even a small emergency fund, then thinking about how precious metals might fit into your broader financial strategy becomes a legitimate and worthwhile conversation to have. Now, let me give you the silver picture one more time because I want it to really land. Silver right now is trading at what many analysts consider a historically wide discount to gold. There's a ratio that precious metals analysts track called the gold-to-silver ratio. It tells you how many ounces of silver it takes to buy 1 ounce of gold. For most of the 20th century, this ratio averaged somewhere in the range of 40 to 60. In other words, an ounce of gold would typically buy between 40 and 60 ounces of silver. In recent years, this ratio has been significantly elevated, at times exceeding 80 or even 90. What that suggests from a historical context is that silver is relatively cheap compared to gold by its own historical standards. Now, that ratio can stay elevated for a long time. Ratios can also change because gold gets more expensive rather than silver getting cheaper. So this is not a simple silver is cheap, buy it argument. It's context. Historical context that many precious metals investors pay close attention to when thinking about relative value between the two metals. And here's the part I find genuinely fascinating from an industrial standpoint. Silver's dual role as both monetary and industrial metal means it has two separate demand engines running simultaneously. If the economy is strong and industrial production is running hot, solar panels being built, EVs being manufactured, electronics flying off assembly lines, silver demand goes up from the industrial side. If the economy weakens and investors flee to safety, silver demand goes up from the monetary side. It's one of the few assets on the planet where both a strong economy and a weak economy can drive demand. That is an unusual and, I'd argue, underappreciated characteristic. Stay with me because we're getting close to the end, and I want to leave you with something actionable, something you can actually take away from this conversation today. So let's bring this all together. What is the setup nobody sees that I've been building toward? It's the convergence of five distinct forces at the same time, in the same direction. First, real interest rates that appear positioned to compress as the Federal Reserve eventually pivots toward an easier monetary policy, removing one of the key headwinds that has historically weighed on precious metals. Second, central bank gold demand that is running at historically elevated levels and represents a structural, persistent bid in the gold market that most retail investors don't factor into their thinking. Third, a silver supply deficit driven by industrial demand, particularly from the energy transition, that is creating a fundamental mismatch between supply and demand that the market has not fully priced in. Fourth, a massive pool of capital sitting in money market funds earning short-term yields that will need to find a new home when those yields compress, and hard assets have historically been one of the beneficiaries of that rotation. And fifth, the broader macro environment of persistent government deficits, elevated debt levels, and the slow structural shift in global reserve composition away from pure dollar dominance, all of which are long-term tailwinds for assets that are not dependent on any government's promise to maintain their value. None of these five things on its own is a certainty. Markets are complex. Unexpected events change everything. Policy decisions can shift the calculus overnight. But the convergence of all five simultaneously, that is what makes this a setup in the analytical sense. That is what makes it different from the isolated arguments you've probably heard before. Now, I always come back to the same core message because I think it's the most important thing I can say. The goal here is not to make you chase the next hot trade. The goal is to help you think more clearly about the role that different asset classes play in a well-constructed financial strategy. Gold and silver are not magic. They are not a guaranteed path to wealth. They are a specific tool with a specific function, and understanding that function and whether it fits your situation is the work. Your work, in partnership with professionals who know your specific life. What I hope you're taking away from this conversation is a richer, more complete understanding of why these markets are moving the way they are, what the structural forces look like underneath the surface, and why the setup building right now is genuinely different from the noise and hype that typically surrounds precious metals discussions online. Here's what I want you to really hear as we wrap up. Gold has historically served as a store of value across centuries of economic upheaval, not because it's perfect, but because it's real. Silver carries with it a dual demand story that is uniquely powerful in the current macro environment. The real interest rate dynamic is real and measurable and historically significant. Central bank behavior is a structural signal that goes beyond quarterly sentiment. And the pool of capital sitting on the sidelines waiting for yield compression to give it a reason to rotate. That is a genuine, quantifiable force that most everyday investors have never once thought about. And look, I get it. If you've made it this far, you're the kind of person who actually wants to understand this stuff. You're not looking for someone to hand you a hot tip. You want to actually understand the dynamics at play so you can make smarter, more informed decisions about your own financial future. And that, honestly, is what this channel is about. If any part of this resonated with you, if this gave you a new lens for thinking about gold and silver or raised questions you want to dig into further, drop your thoughts and questions in the comments below. I read every single one. This community is full of people who are genuinely trying to be smarter about money, and the best conversations happen right there in the comments section. If you got value from this video and you want more honest, no-nonsense financial content that actually respects your intelligence, hitting that subscribe button is the best way to make sure you're here for what's coming next. I don't post fluff. Every video is built to give you something real. And speaking of what's coming next, in my next video, I'm going to dig into something that even a lot of experienced investors get completely wrong: the relationship between the US dollar and commodity prices, and why understanding that relationship is one of the most powerful macro tools any investor can have in their toolkit. If you think you already know this story, I promise you there's an angle in that video you have not seen laid out the way I'm going to lay it out. You're going to want to be here for that one. Until then, stay curious, stay disciplined, and keep asking the questions that most people aren't asking. That's how real financial clarity gets built. I'll see you in the next one.